For more stock news updates, remember to press the like button and subscribe. With that being said, let's get straight into the video. The fourth quarter has delivered a rich array of critical financial and economic data, keeping investors thoroughly engaged. As November unfolded, Wall Street witnessed a wave of activity, with hundreds of earnings reports flooding in from some of the most influential companies in the market. Furthermore, numerous economic data releases offered essential insights into the potential direction of the Federal Reserve's monetary policy. These events provided critical context for market participants as they navigated an increasingly dynamic landscape. Among the many notable developments during this period, one key deadline took center stage on November 14th. This marked the final opportunity for institutional investors managing assets worth at least $100 million to file Form 13F with the Securities and Exchange Commission. These filings are an invaluable resource for market enthusiasts and analysts alike, as they provide a detailed overview of the stocks that some of the most prominent Wall Street investors bought and sold during the preceding quarter. In this particular case, the reports covered trading activities for the quarter ending September 30th. While much attention is often focused on Warren Buffett, the chief executive officer of Berkshire Hathaway, as one of the most closely followed investors in the market, he is far from the only noteworthy name in the investment world. Another highly regarded figure who draws significant interest is billionaire Stanley Druckenmiller. With a long-standing reputation for astute market decisions, Druckenmiller oversees nearly $3 billion in assets through his investment firm, Duquesne Family Office. His track record and unique investment approach make his quarterly moves a subject of great interest to financial experts and casual observers alike. Druckenmiller is particularly known for his balanced and diversified investment strategy, which spans multiple asset classes. His portfolio often includes a mix of stocks, bonds, stock options, and currencies, reflecting a sophisticated understanding of market dynamics. He also utilizes both long and short positions to hedge risks and capitalize on market opportunities. However, it is essential to note that short positions are not disclosed in the quarterly Form 13F filings, limiting the visibility of his complete portfolio strategy. One of the most intriguing aspects of Druckenmiller's investment activity during the third quarter was his strategic maneuvers within the artificial intelligence sector. In a move that caught the attention of many, he significantly reduced his stake in one of Wall Street's most prominent AI companies, Palantir Technologies, while simultaneously increasing his exposure to another rapidly growing competitor in the AI space. This decision highlights Druckenmiller's agility and willingness to adapt his portfolio in response to evolving market conditions and opportunities. Historically, Druckenmiller and his team at Duquesne Family Office have demonstrated a high level of activity, frequently adjusting their portfolio to align with their investment outlook. On average, the fund's top 10 holdings are retained for just 2 quarters, reflecting a dynamic approach to capital allocation. As of the end of September, the firm's 75 holdings had an average holding period of just over 2 quarters, further emphasizing the fund's proactive strategy. Among the numerous stocks that experienced reductions or complete exits during the third quarter, none stood out more prominently than Palantir Technologies. At the beginning of the quarter, Duquesne Family Office held nearly 770,000 shares of Palantir. By the end of the quarter, this position had been drastically reduced to just over 41,700 shares, representing a staggering reduction of approximately 95%. This dramatic reduction in Palantir shares was likely influenced by several factors, with profit-taking being one of the most plausible explanations. Palantir's stock has experienced a phenomenal rally, with its year-to-date performance showing an impressive gain of 335% as of December 17th. Such a meteoric rise in a relatively short time is rare, even for market-leading companies, making it a logical moment for investors to secure profits. Notably, Druckenmiller's fund initiated its stake in Palantir during the fourth quarter of 2023, meaning the substantial price appreciation provided an opportune moment to realize gains. Palantir's stock performance has been underpinned by several factors, including its decisive shift to consistent profitability and growing demand for its AI-driven platforms, Gotham and Foundry. The Gotham platform, a key component of Palantir's offerings, is extensively used by federal governments to analyze data and plan critical missions. Meanwhile, the Foundry platform enables businesses to interpret and derive actionable insights insights from their data. At present, Gotham's multi-year contracts with federal governments serve as Palantir's primary driver of profitability. However, Druckenmiller's decision to reduce his holdings in Palantir may not have been motivated by profit-taking. There are other factors at play that could have influenced this move. Over the past 3 decades, history has shown that revolutionary innovations often require significant time to mature and achieve their full potential. While artificial intelligence holds immense long-term promise, it is unlikely to be an exception to this trend. Should an AI bubble emerge, Palantir's stock could be adversely affected, potentially leading to a sharp decline in its valuation. Additionally, there are practical limitations to Palantir's Gotham platform which may have influenced Druckenmiller's decision. Gotham's services are primarily available to the United States and its closest allies, effectively limiting its long-term customer base. This constrained market could pose challenges for Palantir's growth trajectory in the years ahead. Furthermore, Palantir's valuation has raised concerns, with the company trading at approximately 69 times its trailing 12-month sales. Even with its competitive advantages, this valuation appears difficult to justify, particularly in a market environment where valuation discipline is increasingly important. Interestingly, while Druckenmiller reduced his exposure to Palantir, he significantly increased his investment in another AI-focused company, Broadcom. During the third quarter, Duquesne family office added nearly 240,000 shares of Broadcom, a company that recently joined the exclusive ranks of trillion-dollar valuations. Broadcom has established itself as a leader in AI networking solutions, offering critical technologies that facilitate seamless connections between graphics processing units while minimizing latency. These capabilities are essential for AI-driven systems that rely on real-time decision-making. In fiscal 2024, Broadcom reported $12.2 billion in revenue from AI-related sales, representing an extraordinary year-over-year growth of over 220%. Broadcom's growth trajectory in the AI sector appears promising, with its chief executive officer projecting that the company's 3 largest clients could collectively spend between $60 billion and $90 billion on custom AI-integrated chips over the next 3 years. Beyond its AI-related offerings, Broadcom maintains a diversified portfolio of technologies, including wireless chips for next-generation smartphones, cybersecurity solutions, and optical sensors used across various industries. Druckenmiller's interest in Broadcom may also stem from its robust capital return program. Since introducing its first quarterly dividend in 2010, Broadcom has increased its payouts by over 8,300% on a split-adjusted basis, reflecting the company's commitment to returning value to shareholders. Nevertheless, Broadcom's valuation presents a potential challenge. The company currently trades at 22 times its trailing 12-month sales, representing a premium of over 166% compared to its 5-year average price-to-sales ratio. Sustaining this level of valuation will likely depend on Broadcom's ability to achieve its projected sales growth in the mid to high teens over the next 2 fiscal years. In summary, Stanley Druckenmiller's third quarter portfolio adjustments underscore a strategic shift within the artificial intelligence sector. His decision to significantly reduce his stake in Palantir reflects concerns over valuation and market dynamics, while his investment in Broadcom highlights the company's strong position in AI networking solutions and its diversified revenue streams. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.